we go. Okay. Welcome. Good afternoon, and welcome to our 2021 webinar series, proudly sponsored by BKD. My name is Kim Medina with the Fort Collins Area Chamber. I'm sorry, I have too many buttons popping up at me. There we go. We'll just do it this way, then we'll share our screen. Thank you again for joining us. Just a few housekeeping items before we get started. Please make sure you stay on mute throughout the course of the presentation. We will have time for Q&A, so please do put your questions in the chat throughout the presentation, and Brian will answer those after we are concluded. We are recording it, and we will send you the recording and Brian's handouts after the presentation so that you can go back and review, and if you have any questions, please contact Brian. With that, I'm excited to introduce you to Brian. He's a CPA with BKD. He's going to walk us through the latest COVID-19 stimulus bill and what it means for us as business owners and individuals. Brian has more than 12 years of public accounting experience and 3 years as a tax supervisor. He provides tax consulting and compliance services to closely held businesses, primarily in the construction, real estate, manufacturing, and distribution industries as individual and family tax planning. He has significant experience working with partnerships, family offices, portfolio companies, and other privately held companies. Brian also leads the construction and real estate practices for BKD's Colorado offices. He has conducted numerous internal training sessions regarding tax issues and has authored articles for various industry publications in construction and real estate. Brian is a member of the American Institute of CPAs and the Colorado Society of CPAs. He is a 2012 graduate of Downtown Denver Leadership Program, as well as a 2014 graduate of Impact Denver. Brian holds a certified construction industry financial professional certification. Thank you again, Brian, for presenting to us today. And with that, Brian, we're going to turn it over to you.
Sounds good. Let me see if this will work.
There we go. Perfect.
So Kim, thank you very much. I appreciate the introduction. Just a quick note, we're proud to be a sponsor of this webinar series with the Fort Collins Chamber. A little bit of background aside from what Kim's already told you is I grew up in Northern Colorado. I actually grew up in Greeley, went to Northern Colorado for school, and since then moved down to Denver. I've been down here a little while, but still have family up in Northern Colorado, so I get up there quite a bit, and so I'm excited for the opportunity to present on this and to present to businesses and individuals up in Northern Colorado. Today, we are going to try to keep this kind of high level on what we're going to cover. You know, I don't think anybody wants to get into the weeds too much of some of the stuff, but I do think it's important. At this point in time, probably a lot of folks already are familiar with the Paycheck Protection Program, PPP loans, and some of just the nuances with that, some of the changes that have occurred through that. And so really what we're going to try to cover is, you know, I might do a little bit of background just on what the PPP loan is, when it started, kind of what the initial setup was, but then also what changed in the last round of stimulus legislation, which was passed in December of 2020. So we'll cover PPP loans. Additionally, we'll cover some other just tax-related provisions that were also included in the latest stimulus legislation. Some of that was tax credits. Some of it is just business and individual tax changes that, you know, might be of interest to you. And then at the end of that, we'll follow it up with just questions you have. Hopefully I can answer them. If not, I can, you know, we'll definitely follow up with you guys after the fact to answer any sort of questions you might have. So, with that, we'll jump in. So like I said, there's been several rounds of legislation that have passed since let's say March of 2020. So once kind of the full brunt of coronavirus hit, and the government realized that there were needs in both the business and the individual taxpayers. They started kind of rapid fire proposing and passing a bunch of legislation that was aimed at helping businesses get through the pandemic. And so the latest kind of iteration of this was the Consolidated Appropriations Act of 2021. So this was passed, signed into law sometime in late December 2020. And so the bill really kind of had two different parts. One piece of it, this $900 billion, was specifically for COVID-19 related relief. A lot of it was, in addition to previous COVID relief that had already been passed. And then the other part of the bill was just kind of a general spending bill for the government to get them through most of 2021. So you can see what was included in the bill. And so there was a lot of changes to the PPP loan program. We'll go through a lot of this in more detail, but the biggest changes were, they added a second round of PPP. So for businesses that had already gone through and got a first round of PPP, there was now the ability to go through and get a second round of funding as long as you met certain criteria. Another real big one that, I personally have been working through a lot with just my clients is some of the payroll related tax credits that were expanded with this Consolidated Appropriations Act. And so really those are kind of the main two things I'd like to hit is on the changes to the PPP program and also some of these tax credits that were expanded. You can also see there were some things that were not included in there. I think the government, that part of the challenge this last year is that, a lot of these changes have come out very quickly. And because of that, as Congress passes legislation and as the Treasury and IRS start having to go through and kind of implement some of this legislation that was passed, the challenge has been is that it's constantly kind of changed as they're going through and interpreting the legislation and trying to figure out how to kind of operate this legislation and make it available. Anybody who's familiar with these can attest to the fact that it's constantly changing. It's been tough because on a week, sometimes on a daily basis, different regulations have come out, different interpretations, and so it's been a bit of a challenge this last year just to kind of keep abreast of what's been going on. And so, I think they did a fairly good job of covering this, but you can see that not everything that I think people wanted included actually ended up in the final bill. So again, this first piece I'd like to cover is the Paycheck Protection Program. I'm hoping at least some of you are familiar with what this is. I think for a while I was kind of hoping I wouldn't have to deal with any more Paycheck Protection Program issues, but in all reality, it's actually been very helpful to business owners and folks who have been hit by COVID-19 who are trying to keep employees paid. They're trying to keep the businesses open. And so this has been kind of a vital step to bridge, the lack of business, the shutdowns that have been in place in a lot of areas of our state and throughout the country. This is intended to help get businesses through the pandemic until things will start loosening up again. So I thought maybe before I get into what changed on the PPP loan, I'll do kind of just a quick kind of recap of what that is for people who might not have been familiar with it. The PPP loan came around initially, almost a year ago, I think back in March of 2020. They set this program up. It's administered through the Small Business Administration. And so initially, it was really easy to qualify for a PPP loan. Basically what they said is you have to have under 500 employees. You have to have had some sort of payroll, and you have to kind of attest to a need for the loan. And at first that was all it really said was, your business had to have been affected somehow by COVID-19. There had to be uncertainty in your business. And so because of that, you needed this loan. So really at first, almost anybody who was under 500 employees and who had some sort of payroll or kind of self-employment earnings, because there is a way if you're a sole proprietorship or certain other business entities. So you had to have that because that's what the loan is calculated off of. So, and then again, like I said, you had to be able to kind of certify that you needed the money. And so back in March and April of 2020, when they started this program, there was actually a really big rush for businesses to get lined up to go get loans, because there was only a finite amount of money set aside for the PPP loan. I can't remember at this point exactly what that first round was, but it was several hundred million, but it was, it wasn't unlimited. It was a finite amount. And so there was a real kind of rush initially for businesses to get in touch with their banks and to go through the process of getting the loan. And so so hopefully that's kind of just a high level thing. And so the loan was calculated. Basically, you took an average payroll expense for your business, you multiplied that by 2.5, and that was the amount of loan you could get. Now, once you got the loan, you had to spend that loan on certain kind of qualified expenses. The main expenses were payroll, rent, utilities, certain debt obligations could qualify. But really the premise was you get the money, you spend it on payroll for your employees to help keep them, your staff employed. And as long as you did that, then the loan would be forgiven. So you would go through a process of kind of saying that you spent all of the loan proceeds on the right expenses. And if you did that, the loan was forgiven. You didn't have to pay it back. So setting that as kind of just high level, here's what the PPP loan is. I'll go through a couple of things just specific to this last legislation that changed, that I think for the most part, all of these are favorable changes. The big change, and where there was a lot of confusion and maybe anxiety prior to this, was when the initial PPP came out, Congress was fairly clear saying that the intent of this was not to have this loan be taxable. And the way that loans are typically taxed is if you take out a loan and you do not pay the loan back, and so the loan is forgiven, then you typically then have to pick that up as debt forgiveness income or cancellation of debt income and pay tax on that. And so, when it first came out, Congress said, the intent of this is that this can be forgiven and also is not taxed. And so I think that, obviously that's a huge reason why people wanted to go and get these loans, is because you were able to get money that ultimately, if you spend it on the right expenses, was going to be forgiven, and you also didn't have to pay tax on it. So it was kind of the best of all worlds. It's kind of just a tax-free grant that you were able to get. And so not too long after that, the IRS came out with some regulations, around the PPP loan. And one of the big ones that they came up with was to say, okay, we agree that the debt forgiveness income is not going to be taxed, but our interpretation is then any related expenses. So let's just say, for example, you had a $50,000 PPP loan and you spent all $50,000 on payroll expenses, that the IRS's interpretation was, okay, the $50,000 of debt forgiveness income, not taxable, but the payroll that you used, the $50,000, which is included in your payroll expense for the year, is now is non-deductible. And so, and there is some kind of historical precedent there related to, the IRS was essentially saying this is tax exempt income. And so any expenses that you incur related to this tax exempt income are also non-deductible. But what that did, if you kind of work through the mechanics of it, is it essentially made the loan amount taxable by way of reduced expenses. And so a lot of people in the rush to go out and get a PPP loan didn't necessarily think about that, because initially, like I said, the communication was that this was non-taxable. And so a lot of people went out and got a loan, and some of these loans, depending on how big your business is and how many employees you have, were quite large. And so then when it started coming time to say, okay, we need to ask for forgiveness, we've spent all the money, people were, having to start thinking about, okay, I've got to pay tax on, whatever amount of loan I get forgiven. And so really one of the main kind of taxpayer favorable changes that came out of this latest stimulus bill was that they specifically said, hey, the expenses that you used your PPP proceeds on are deductible for tax purposes. The forgiveness of debt income is not taxable, and the expenses are deductible. So this is a huge benefit to businesses who took out these loans. Now, instead of having to think about, from a cash flow perspective, how to pay for the taxes related to this, it's now clear that, the loans that are forgiven are now deductible. So that's one of the main changes that came about. Just real quick on this last point here, part of the issue is that a lot of, that at least my clients are kind of dealing with, is the fact that the expenses were all incurred in 2020. So again, using the example of a $50,000 loan, you spent all of the loan on payroll, so it's included in your payroll expense for 2020, but we haven't applied for forgiveness yet to the bank, or maybe we did, but the bank hasn't let us know what if it's been forgiven or not. And so what that means is, that you are able, if you're a pass-through entity, to increase your basis by the amount of the loan that is forgiven, or I think if there's a more reasonable than not belief that'll be forgiven, you are able to increase your basis in it if you have a pass exempt entity to help deduct those losses that were incurred in 2020. Another sort of taxpayer-friendly, expansion of, I guess, what the initial PPP program said is that they did include 4 additional areas of expenses that you can now use PPP loan proceeds on that will count for loan forgiveness. So, and like I said initially, that really the 3 main sort of buckets you could spend the loan on was payroll, rent, utilities, and some debt costs. Now they've expanded this to include operation expenditures. This really, if you look at the details, is mainly like software and kind of cloud-based services that business might use. Covered property damage. This is really if you had a business that was damaged due to some of the protests and sort of demonstrations that went on in 2020. If you had a business that incurred damage because of that was not totally covered by insurance, if there was additional cost, out-of-pocket cost, that now qualifies. And then a couple of other things too, some supplier costs, and then also expenses for outfitting your business for kind of COVID-19 related protection. So if that's sneeze barriers or additional sort of costs that you had to incur for specific to protection for your employees, that counts now too. So it's expanded what you can use the money on. Now keep in mind, make sure I say this too. There's always been a limitation that at least 60% of the loan has to be used for payroll costs. So, if you do have a PPP loan, you do have to have at a minimum spend 60% on payroll, and then the other 40% can be any of these other costs that I went through. And this will come into play a little bit more when we talk about some of these payroll tax credits. We'll go through this real quick. So they did expand some of the timelines to apply for PPP loans. You can see that they opened the window until March 31st of this year to apply for even an initial PPP loan. And they changed, if you went through the process or if you looked at it, back when it first came out, there's certain periods that you have to look at to say, okay, what are my payroll expenses? What do I qualify? And so there was a bunch of sort of covered periods that you would have to look at to see if you qualified. They did expand those as well with kind of the expansion of this, the date to apply for a loan. They also expanded some of the time periods that you can look at to see if you qualify. Another big thing too, at first when this loan came out, the mechanics of the loan, like I said, was you came up with an average monthly payroll cost. You multiply that by 2.5, and that was your loan amount. And part of the, initially the problem was they based the loan off of 2.5 months of average payroll costs, but then they said, okay, you have a covered period, which is the period you have to spend the money, of 8 weeks. And so right off the bat, people were kind of scratching their head and saying, okay, well, you gave us a loan based on 10 weeks, and then you said we have 8 weeks to spend it to have everything forgiven. And so if you didn't have a lot of those other costs outside of payroll, like rent and utilities and all that, you were having kind of a hard time spending all the money because the period in which you spent it was less than what they based the loan off of. So they shortly after that, they basically said, hey, we're going to expand this from 8 weeks to 24 weeks. And that kind of alleviated a lot of these problems. It helped a lot of businesses because if you use 24 weeks, almost everybody had plenty of expenses in that period to have full loan forgiveness. Now, the problem was it was either 8 or 24. You couldn't pick anything in between. And part of the problem was, if you picked the longer 24-week period, it also meant that because there are some functions in the PPP forgiveness mechanics that during that covered period, if you reduce your workforce, if you lay people off, or if you reduce payroll, or if certain other things come into play, then it factors into how much loan can be forgiven. So if let's just say you had a large reduction in full-time employee counts during that covered period, it could mean that, you might not be able to have the full loan forgiven. So initially, they said either 8 or 24 weeks. And so there wasn't much flexibility because if you went with the 24, which most people did to get the full forgiveness, you also had to make sure that you kept everybody employed. You didn't have any sort of payroll reduction for the full 24 weeks, even though you might only need 10 weeks to have full forgiveness. And so another big, kind of correction that they did is they now said, hey, you can pick any time between 8 and 24 weeks. It's not one or the other. It's whatever you want. It's got to be at least 8 weeks and not more than 24, but you can pick any covered period in between those dates that fits, the window you need to make sure the loan's forgiven. So it's allowed more flexibility for people in terms of what covered period they use to calculate the loan forgiveness. They changed how farmers and ranchers calculate, and one of the problems initially with the for farmers is they normally file what's called a Schedule F on their tax return. And initially they had to calculate their PPP loan on net income. And sometimes, it's not that uncommon for net income to maybe be zero or negative, or, and so they were having a hard time qualifying for PPP loans because of the fact that they had to use net income. So they did change that and say, okay, now specifically for farmers and ranchers, you can now use gross income for purposes of coming up with that monthly income amount to calculate a PPP loan. So that, that was a nice perk for farmers and ranchers who are looking for a PPP loan. I'll go through these real quick. So another nice thing is if you have a PPP loan of $150,000 or less, they've now significantly simplified how to get that forgiven. Instead of going through the full loan forgiveness application you have to submit to your bank, there is now kind of a one-page document where you just have to provide a couple of pieces of information, number of employees, amount of loan that you spent on qualified expenses, and so really, anybody who has a loan of 150 or less, or if they get a second round PPP loan of 150 or less, there's now a very simple process of asking for forgiveness. Because if anybody's gone through the process of calculating and filling out the PPP loan forgiveness income, they can attest to the fact that it's pretty complicated, and there's a lot of information that banks are requiring that you submit along with it. So this, it's a nice thing for small businesses who got smaller loans to have an easier way to get this forgiven. Let's see, we'll go over, real quick. They initially, I think there was some worry on people who got PPP loans. If you can remember back to last year, a month or two after the program was put into place, you started hearing these stories of large companies who were, minimally impacted by the pandemic, who had access to other capital, but had went ahead and got very large PPP loans. And so some of that, it made its way to the press. And so I think at the time, the Secretary of the Treasury, Mnuchin, came out and basically kind of said, hey, listen, we're going to take a real close look, because like I said, one of the things you had to do when you ask for a PPP loan is you have to certify under penalty of perjury. You have to sign a form saying, hey, we kind of certify that we need this loan, that we've been adversely affected by COVID-19, and so we're sort of attesting to the fact that we need this money. And so I think initially, depending on how large your loan was, some people I think got nervous, and even though they got a loan, they just immediately paid it back. They didn't want to have SBA coming in and looking around and possibly challenging whether or not they needed the loan. So there were a lot of instances. I didn't see too many of these, quite honestly, but where people took out a loan and then just immediately paid it back. Just said, I don't want to have to deal with this. I'm not sure what exactly they mean by, the certification. I just don't want to deal with it. So they have come out and said, okay, now that you sort of know, you have the benefit of a year, there's been some clarification on size of loans, what the SBA will look at. And so they are saying, hey, if you initially got a loan or just, did not take a loan out because you weren't sure, you have another kind of do-over. You can go back and ask for either, an initial loan or, in that second point, if you took a loan that was smaller than what you otherwise would qualify for, you can go back and ask for the difference between what you got and the maximum you can qualify for. they expanded it a little bit, especially in tax exempt organizations who can be eligible for a PPP loan. So won't get into a lot of detail, but they did, I think, from the initial kind of list of who could get a loan, they expanded that. Another big change on the PPP was just this second draw. So they allotted additional, I can't remember exactly what the amount of money they set aside. Essentially, they said, hey, if you got a first round PPP loan and you spent all of the first round PPP loan on qualified expenses, and you expect either your loan has already been forgiven or you expect it to be fully forgiven, then you can go back for a second round of PPP loans. And so again, for a lot of businesses that this is very welcome news. This is, especially now that there's clarification on the fact that this isn't taxable, that you're able to deduct the expenses, that there's these expanded, sort of expenses you can use. They've really loosened up, ability to get the loan and get it forgiven. And so now they're giving certain businesses another round of loans. Now, the big difference on this is that initially, like I said, to initially get a PPP loan, really under 500 employees, you had to have some sort of payroll or net income to base the loan amount on, and you had to be able to attest that you needed the loan. On this second round, they've limited it even further, I think, just to try to target businesses that have been harder hit than others. Because the reality is, now that we're almost a year into this, depending on what industry you're in, some businesses were hit much harder than others. And so really, they limited the amount of employees from 500 to 300 on the second round. They also put in a revenue decline that you now must show. And so now you have to be able to show a 25% decline in gross revenue in any quarter in 2020 compared to 2019 to be able to qualify for a second round loan. So aside from that, the rules are basically the same. It's just that you have to, really the big difference is you have to be able to show that you have a revenue decline in order to qualify for a second round loan. I won't go through this a whole lot. If you have the slide deck, you can look at it, but basically it just kind of says, if you weren't in operation, if you weren't like a business for the full year of 2019, how do I go about kind of calculating, have I had a 25% reduction in gross receipts? And so you can look through this. It kind of tells you, hey, if you're a full year, if your business was operating full year of 19, then you look at any quarter of 2020 compared to the corresponding 19 quarter for purposes of seeing if you have that revenue decline. Like I said, same rules apply. They did earmark some of the funds for some of these smaller businesses to make sure that there's, that the funding doesn't dry up if there are larger businesses that get to it first. And so they did do some set asides for businesses that are small business. So the other relief provisions, I'll go through real quick just in the sake of time, but just so that you're aware, they did include a grant for what they call shuttered venue operators. So this is, museums, live event venues, movie theaters, acting, talent reps for actors, that sort of thing. So in a lot of these businesses were just non-existent in 2020. If you think about, music halls or movie theaters, they don't have a 25% decline. They might have a 100% decline of revenue, and so they set aside a special program to say, hey, if you are one of these businesses, and there, again, like anything else, there's certain qualifications that they have to be able to show. Then there's specific grants available from the government for these businesses to utilize. And so, like I said, I won't go through this one a whole lot because I don't think it applies to a lot of businesses. But if there are some, there's some of these businesses. I know we've got one down in Colorado Springs that is taking advantage of this because it's a hall that people come to for meetings and stuff, and they've literally not operated last year, aside from maybe the first couple months of the year. So just know it's out there. You can look through here on what you can use the expenses on. It's pretty flexible on what you can use the grant for in terms of business expenses. There is a kind of a priority on who gets the grants, and it's based on whoever, I think, who can show that they've had the largest decline in revenue. So if you look through this, the first kind of priority is for people who their 2020 revenue is 10% or less of what it was in 2019, and then it sort of ratchets up. There was some provisions for additional school funding, some rental assistance, and then some additional kind of vaccine-related programs that were provided, I think, additional funding in this last stimulus bill. So real quick on the payroll credits, really the big one that I want to go over just to make sure people are aware is this employee retention credit. So initially, this has been around for, again, almost a year. I think the initial employee retention credit came out in March or April of 2020. But, a lot of people honestly didn't think about it because initially when they came out, they said, if you qualify or if you take a PPP loan, then you can't also take an employee retention credit. And so I think most people who looked at it found that the PPP loan was going to be more lucrative for them, was going to result in a larger amount of benefit. And so at least most of my clients didn't really think about it, the ERC credit, because they were focused on PPP loans. And so that was the case all the way up until December of 2020. Same rules applied. If you took a PPP loan, you could not also take an employee retention credit. And in the Consolidated Appropriations Act, they changed that and kind of expanded this credit to say, hey, if you took a PPP loan, you now can qualify for this credit. The only limitation is you can't use payroll that was paid for by a PPP loan to calculate this credit. But for a lot of taxpayers, they had additional payroll outside of what was funded through PPP in 2020, and so for them, and I'll get into this real quick, but I think what people have found is that the benefit, the amount that these credits can be, start racking up very, very quickly. There are, again, like some qualifications on revenue declines and certain things that have to be met. But if you can do that, the amount of tax credits you can get through this program sometimes are pretty staggering. So the big change was that prior to December of 2020, you could not take an ERC credit, also a PPP loan. They changed that to say, okay, you can do both. You just can't use PPP to calculate your credit. This and they also expanded it for now. Sorry, there's an ERC credit for 2020. That's kind of got its own set of calculations, and then they expanded it to the first 2 quarters of 2021 to say, hey, we're going to not only allow the credit for the first 2 years of 2021, but we're also going to loosen it up a little bit. We're going to increase the amount of credit available. We're going to also increase how many credits you can get. So if you haven't looked at this, I encourage you to take a look at this and see if it's something you might be able to take advantage of, because in my experience, in the clients I've talked to and who can qualify, this is a huge deal. This is a credit against payroll taxes. It's not an income tax credit. It's a payroll tax credit, but you know, it for businesses that doesn't matter a whole lot. Payroll taxes are a big part of their cost, and also there is an ability of the ERC credit to have some of it taken, you know, beforehand. So, you know, instead of you normally file a payroll return on a quarterly basis, and so the IRS has allowed you to ask for some, you know, to quantify the credit, and then you can have some of that paid to you before you even file your quarterly payroll tax return. So you can, you know, initially in 2020, the ERC credit had a credit rate of 50%, and that was on kind of a maximum per year wage amount of $10,000 per employee. So at the end of the day, if you kind of work through the calculations and for every eligible employee you had, the maximum credit was $5,000 for the year. So if you had 10 employees, that was a $50,000 of payroll tax credits for the whole year. They extended that to 70% for the first 2 quarters of 2021. So that $5,000 credit is now $7,000 credit per employee. They also changed it to say for 2020, it was a $5,000 credit maximum for the whole year. For 2021, they're saying if you have eligible employees, then it's a $7,000 maximum credit quarter. So instead of, like, you know, let's just say pick one employee, if they worked all of 2020 but also worked the first 2 quarters of 2021, credit for that one employee in 2020 was $5,000 max. For 2021, that credit is now $7,000 per quarter, so $14,000 maximum per employee. So it's greatly kind of expanded the amount of credits available for those first 2 quarters in 2021. The biggest thing you need to kind of look at is, it is based on number of employees, and so they are different for 2020 and 2021. Basically, in 2020, if you're under 100 employees, then all of the, you know, qualified payroll costs would count. If you're over 100 employees, then you can only calculate the credit on payroll costs that you pay to employees who are not providing services. So what that means is, like, you can only calculate wages where if your business was shut down, but you continued to employ your staff, you didn't lay anybody off. And so you can only, if you're over that 100 limit, you can only calculate the credit on that time paid to employees who are not working. For 2021, they expanded that to 500 employees, that limit. If you're under those limits, then all, you know, 100% of the wages qualify, regardless of if they're providing services or not. You know, I kind of went through that. You can kind of go and see that the credit in 2021 is going to be a lot bigger than it was in 2020 if you can qualify. The other big thing, I don't know, I must have passed it. The other qualification is to qualify for this credit in 2020. There's two tests. One is you have to be able to show a 50% decline in gross revenue on a quarter, you know, same kind of test as it was for PPP. Look at a quarterly basis. Can you show that in any quarter in 2020 compared to to 2019, you've got a 50% decrease in gross revenue? I mean, that's kind of hard for a lot of businesses, though maybe not, you know, businesses in the hospitality or some of those other hard hit sectors, but so you had to be able to show a 50% decline, or the other qualification was at any time during the year, your business was partially or fully shut down due to government, like a government order. So you could qualify either way. In 2021, they they changed that from 50% decline in gross revenue to 20%. So it has made it easier for some businesses to meet that 20% threshold in revenue decline. And again, if you can show that you had a 20% decline in revenue, or your business is partially or fully shut down, then you can qualify for the credit, and you can go through the calculations and kind of quantify what that might look like. So hopefully that makes sense. I don't want to get to too much detail on it, but just take a look at that, because as we've worked through it the last kind of month and a half or so, it's been a huge benefit for a lot of our clients. A couple other things. There was just some expanded credits related to, they had kind of mandated some required sick leave for folks who contracted COVID-19 or had family members who contracted COVID-19. There were employers were required to provide sick leave for them, and there was a kind of a credit that the employers could get for that payroll tax. That was expanded. Expanded through March 31st, 2021. So I know we're getting kind of close on time. I'll go real quick. These are not PPP or payroll tax. These are just some other tax changes that might be, might be worth kind of taking a quick look at. They changed historically for business meals, those have always been sort of 50% deductible. If you have business related meals, you could deduct half of it, and half of it was added back. I think in a, hopefully a move to prompt people to have business meals for 2021, and this should say 2022, they changed that temporarily to say that 100% of business meals are now tax deductible. So for 2021 and 2022, if you have any sort of business meals, those are now fully deductible instead of 50% deductible. There's a couple other, enhancements to some of the tax credits related to low-income housing. They loosened up depreciation. There's a business interest limitation that has been in effect for a couple of years now, and there was this ability for real estate businesses to make an election out of the interest limitation, but to do that, you had to change the lives that you depreciated your assets over. They reduced some of those depreciable lives, and to make it a little bit easier for those people to make this election. Individually, there was a couple of provisions that they included in this last bill. A lot of it is related to charitable deductions. One of them is an above the line deduction. So if you don't itemize your tax deductions, you now can take an above the line kind of special charitable deduction in 2021 for $300 or $600 if you're married filing joint. And also, typically you're limited on how much income you can offset through charitable deductions. So normally that amount is 60%, so you can only reduce your adjusted gross income not more than 60% by, through charitable giving. And they did suspend that for both 2020 and now through 2021, where you can now offset 100% of your adjusted gross income if you have qualified charitable contributions. And so I think mostly that's public charities. You can't do it through a donor advised fund. You can't do it on certain private foundation donations. But if you are, inclined and you give a lot of charitable contributions in 2020 or 2021 to the right organizations, you can basically reduce 100% of your adjusted gross income. A couple other things, you know, they expanded the earned income. So the earned income credits, they are, you know, that's based off of, you know, you have to have a certain amount of earned income. They did change that to say that in 2020, taxpayers can use 2019 income to calculate their earned income credit, you know, realizing that some taxpayers may not have earned income in 2020 if they lost their job or were unable to find a new job. So, you know, the good thing is just on most of these is these are taxpayer-friendly changes. You know, most of these are welcome news because they're either helping individuals or businesses. Last thing before we wrap up is, and you know, I'm sure everybody's aware, is there was a second round of individual economic impact payments. So that went out, I think, in December of last year. I know that there's another round of that in the works as well. And so, you know, keep an eye on that. I don't think, you know, you can look through these if you have questions on any of these other sort of extended provisions. I don't think a lot of these apply to most people, but, you know, I guess the one thing is this, you know, for medical expenses, normally, you know, you can only deduct those if they are, you know, once they exceed 10% of your adjusted gross income. They did change, you know, reduce that to 7.5%. So that makes it a little easier to get a tax benefit if you have to incur, you know, a significant amount of medical expenses. So you can look through. There's a couple other things. If you have questions on any of these, please let me know. I'd be happy to follow up with you. But hopefully that covers most of the business and individual changes that came through in this last round of legislation. So sorry, I know I went through that really quick, and hopefully I didn't confuse you guys too much. But like I said, again, I appreciate the opportunity to present and hopefully help explain this a little bit. So thank you.
Thank you, Brian. I didn't see any questions in the chat, but does anyone just want to unmute themselves and ask Brian a question? Okay. I'm not seeing any takers.
Well,
and again, go ahead, Brian.
Sorry, I think you, you know, hope if you pass my information along, if someone does have a question, you know, I'd be happy to follow up offline, you know, if there's something I can help out with.
Wonderful. Okay. Well, I will definitely send the slide deck and his handouts after the presentation this afternoon, and I'll include your contact information, Brian. Just another big thank you to Brian and BKD for sponsoring this webinar series. We couldn't do it without their support. And I also did want to mention that we do have another webinar scheduled for March 9th. This one will be about the new Colorado labor laws that went into effect beginning of this year. So if you're interested in that information, we will push it out on our website as well. But again, thank you so much for joining us. And Brian, thank you so much for your time today.
Sure.
Wonderful. Have a wonderful day, guys.